Thank you for joining Protos Asset Management Cryptocurrency Investments. Today we have Lasse Clausen from 1KX and we'll discuss decentralized finance.
All right, that's very good. Cool. So, thanks for joining, Lasse. So let's dive in. I basically wanted to kick it off and just briefly about Protos. So as you most know, we are a Swiss crypto asset manager. We are trading Bitcoins and Ether mostly, and have outperformed just the buy and hold Bitcoin and Ether strategy. And that's basically what we offer directly in exchange accounts. And thanks for joining, Lasse. So Lasse Clausen, briefly, I want to mention it. You're a former software entrepreneur and founding partner of 1KX. 1KX is a token network fund with a thesis of embedding crypto economic incentives into everything: transactions, computation, storage, prediction, power. I love it. So, just maybe to start things off, I just wanted to give you just a couple of questions. So, where do you think Bitcoin and Ether is going? Yeah, classic question.
Classic
up or down,
first question.
Or you could
give. Classic first question. I think I think it's going to go up. That's the easy part. The thing is, when is it going to go up? No, I mean, so we generally have we're very like a venture fund with 1KX. But it focused exclusively on open source token networks. More in that in a second. So as a venture investor, you definitely have a long bias for sure, right? We don't trade. We don't try to take short positions when we see some problems in the market. So we definitely think it's going to go up over the medium to long term.
Nice.
In the short term is kind of hard to predict, right? There is like this halving. I call it a meme. It seems to be working right now, though Corona was really, throwing a couple of wrenches in that one.
What do you mean? What do you call it? A meme? What does it mean?
A meme.
Ah, yeah. Okay, yeah.
And it seems to be working. I think, to be honest, like the price of cryptocurrencies is largely driven by Asian investors.
Yeah.
Afterwards, to some degree, Americans, and then, almost nothing from Europe, to be honest. And I think the volumes are just very small compared to Asia, right? And so I think in the last weeks, the correlation to traditional financial assets went through the roof. So now it's really a macro play. Like, how much is Corona going to, affect the stock markets and the broader economy? And and so I think the sentiment in Asia generally, they're about 2-3 months ahead of us in terms of fighting this pandemic. They generally feel more bullish about the economy than maybe like the US right now. However, then you also have this really interesting disconnect between the real economy in the US and the stock market, right? So the Fed is basically saying, no matter what, we'll always give you money to buy more stocks and other assets. And so you have funny things where, it was on Jim Cramer's show on CNBC where it said, highest unemployment rate in history of the US. And, Dow has the best week since 1938.
Yeah, explain that, right? Yeah.
So as part of that, maybe to conclude the price conversation on a more longer time frame, I think, a big part of the Bitcoin story, which we might buy into or not, actually the fund doesn't hold any Bitcoin, privately we do, is that, the central governments around the world, basically economies have structural problems, right, to grow, and governments aren't really able to tackle that. So what they do is they just inflate more currency, the money supply more to sort of kickstart the economy, and it doesn't really work. And so it's going to cause this massive inflation, right? And some hardcore Bitcoiners are really like, okay, you got to, the dollar's going to be worthless, and only Bitcoin will hold value. And I would say to some extent that inflation already happened since 2008, but it was an asset inflation, right? So the quantitative easing is sort of a top-down trickles into financial assets, and we had this insane 12-year bull run in stocks and other things. So I think it already happened, but it didn't really land in consumer inflation and the consumer economy except for real estate, right? So real estate mainly became an investment asset now as well. It's not so much a utility anymore. Yeah. And so it does land in the consumer economy that now my flat white in Berlin and New York and other epicenters, now it costs $5 and $3 goes to rent, basically, right? But it didn't really, consumer and this this is why a lot of Bitcoiners were so, they couldn't put the two things together, because consumer inflation in the US has actually been below targets. And so I think it just went into assets. You had this asset inflation, didn't really spill over into the consumer economy. And likely over the next 5 to 10 years, we'll have another probably even larger, asset bubble or asset inflation, because now it's $4 trillion in quantitative easing. Capital requirements for banks have just been completely scrapped in the US. Kind of, maybe some people even missed that.
Capital requirements? What do you mean?
Capital reserve requirements for banks.
Yeah. Mm-hmm.
And so, the goal is to really flood the economy with a lot of money.
Which they tried before, right? I mean, so it's the same story all over again.
Pretty much.
Pretty
much. And I think it doesn't, the problem that happens is that it ends up in our pockets. Basically, anyone who owns assets, stocks, and other things, we do get wealthier, but it doesn't end up on the street. And the construction worker who doesn't own any assets, who might not be super financially literate, he does get inflated away at some point, right? And I think the problem with that is that you have increasing income inequality, or the perception of, and the people that are left behind are going to be the mass, and then they vote for someone like Trump. And I think Trump is sort of an indirect result of the 2008 sort of economic fiscal response to the crisis, and all these sort of cascading effects that I just described. And my concern is that this will be even much bigger over the next 5 to 10 years. And one way is like, hey, great for us. We own assets, and but maybe Trump was just the beginning, and who knows if you have someone much more extreme being voted in, either on the left or on the right. So I would say that yes, in that aspect, digital assets have established themselves as an asset class.
Yeah,
and will likely actually have the highest upside because it has the least market depth, right? So global stocks is $90 trillion, so it takes a lot of money to move those up. But cryptocurrencies with $250 billion market cap, So that would be my ramblings about price.
Nice. Okay, cool. So I mean, let's. I think it's a good starting point, right? So let's maybe just briefly dive in. What is protocol investing, anyways? I mean, do you wanna talk us through that, and why you think this is different to the other asset classes like equities?
Yes, I would love to, and also thank you very much for having me.
Sure.
So I think the very important thing is about digital currencies, so the first thing is like, okay, they're not all trying to be money, but I think everyone here is more advanced and understood that. They're just software networks that happen to have their own money. In some cases, they're trying to be money, right? Sort of Bitcoin in some way, maybe Zcash like private money. But what we also focus on is basically software networks / protocols that have very specific functionalities, all in the service of an internet of money. Excuse me, an internet of value. And but the very, very important part is here that protocols are not companies. And I think we've had a lot of people rightly question, okay, why is this valuable? Where's the business model? I heard tons of investors asking them for a business model. And in fact, actually, protocols should not have a business model in that sense, in the traditional sense that they sort of have an asset that is proprietary and that they, sort of take commissions or fees on. So that's the first thing I would say, is just protocols are not companies. And to back up a little bit is the fundamental innovation about blockchains is that it's a shared ledger, it's a shared source of truth. Anybody can add entries to that, and also anybody can verify these sort of new transactions. And basically the outcome is trust, right? So you and I, we might come from very different backgrounds, and also, let's say, a third person from China or a third person from China, all over the world, everybody agrees that the Bitcoin that you hold in your wallet, that's it. There's no question about it. You don't need to argue, right? There's trust in that, and there's trust that it's not going to be stolen. And so in a broad sense, you can say that blockchains enable the cost of trust to be almost zero, and now also enable a lot of use cases that before were impossible because the cost of trust was too high, or you didn't have a way to establish trust. Right. And so this is really interesting because the sort of, to our calculations, the cost of trust is around 35% of US GDP. If you extrapolate that from employment. So 35% of US employment is auditors, judges, law enforcement, even managers to some extent. right? So all of these things are cost of trust. And here, in theory, which extrapolates to like a $28 trillion global opportunity, or the cost of trust per year globally is $28 trillion if you extrapolate that up to GDP.
That's pretty bad. Huh?
That's very expensive. That's a lot of money, and you know, and it's very inefficient. So if you think about
how much is a Bitcoin transaction, right? I mean, how much you know, how much does it cost like to transfer 100 million to Bitcoins, right? $1 in Bitcoins.
Exactly, right. So for example, a bank is a good example. Like, why do we pay a bank what we pay? And the main reason is actually that the cost is for the trust, right? We have to know that when I put my money in my bank account, they're not going to run away with it. And now if you start thinking about all the things that have to happen for me to build up that trust, so either it's, you know, if it's a private bank, they invite you to expensive country clubs, you know, the sales guys, his wife hangs out with your wife in the country club, etc. All these things, they cost. They build a brand over a long time. They have infrastructure. They have auditors have to check the software infrastructure, the cost of the regulation. It's very, very high. Now, in theory, you have, you know, a technology that sort of reduces that cost of trust potentially to zero, and especially in financial applications where that trust is very, very important, because I want to know that my money isn't going to be taken away. You can broadly sort of assume in protocols that trust is given. Obviously, there's more nuances to it. Is it on a large, high security network like Ethereum, or is it on something more experimental like Tezos? But let's just assume, you know, cost of trust is almost zero. And when you put money into one of these protocols that we invest into, you don't need to actually trust them anymore, because this whole code base is actually open source. So that means that anybody can start looking into it, verify that if the protocol says, you know, deposit money here, and after 30 days you get, you get some interest or whatever, you can actually verify that in everyone else as well. And again, if you think,
I mean, until it's hacked, right? I mean, there were hacks, you know, personal hacks, as well as let's say smart hacks against smart contracts, right?
Economic attacks, right?
Exactly. Yeah. Well, that also, right? I mean, 51% attacks or something. Sure, right? I mean, but again, I think, you know, it's pretty clear that the large networks, right, are we're pretty confident that you know, Bitcoin is not going to get hacked very, very soon, because if it would be, I guess, you know, there's a big pot of money and people would have tried it, right?
Yes. So it's this $200 billion honeypot that nobody seems to be able to crack, right? And it's out in the open. And so I would say this principle applies. It doesn't mean that, you know, just because something is open source doesn't mean that you're going to have the interest of, you know, 100 smart contract auditors that actually have the ability to verify these things, but it's possible. And a lot of times this is incentivized, right? So it can be peer reviewed, and if you compare that to, let's say I do a trade on the German stock exchange, honestly, I don't know anything. I have no idea what's happening there. I don't know what the code execution is. I blindly trust, you know, because it is an institution. They have a quasi. If you think about it, and you know, if we just don't know, and we think the regulators, we trust them.
Well,
and
you also, you know, like, I mean, my favorite example is always, you know, you think, you know, the bank, you know, your bank statement, it says, you know, you have 5 shares of this, or you have $100,000 in there or something. You really believe that number is true? Because I've worked in banks, and you know, there's a lot of rebooking stuff going on, right? There's a lot of stuff. Oh, you know, this should have been like 100,001 cent or something, or 2 cents, right? And then they figure this out later. And you know, there's always, like, you know, little leftovers, and so it's not carved in stone. You know, like whatever you see on your statement, I would say not carved in stone for sure, right?
Exactly. It's a very, very good point. but you know, we're at this point. I think we had, you know, like a good age, sort of from the 50s post-war. Most politicians were very benevolent. Let's just fix this. Companies mostly were very benevolent. And, you know, and then sort of I would say it started kind of in the 80s, 90s, you know, you saw cases of corporations acting very, very actually maliciously. And part of that, if you see the trust in institutions, businesses, the government, media, NGOs, is actually steadily declining. So this is also what is happening now, is that people don't trust companies anymore. And so this is part of our larger sort of thesis of the fund, that this market for trust, right, which is around $28 trillion a year, which affects almost every industry you have cost of trust, is basically up for grabs. And we think that these, you know, open source, peer reviewable protocols where anybody can become part of that, you know, become a miner, host a node, become a supplier, Anybody can do that, and therefore, they get involved. You have the transparency. It's much easier for these networks to actually gather the trust of all these different participants.
Yeah.
And I would say,
Okay.
right. So one example is the counter example is Facebook coin doesn't get any trust from any regulator, and pretty much nobody, right? Because it isn't really a cryptocurrency. Yeah. It's a corporate network, and again, the trust in corporations is very low. So this is kind of like the the sort of to establish the baseline of what we do. And now
Cool.
you extrapolate this into individual financial primitives, right? That are sort of being rebuilt on Ethereum mostly under that instance, right? And so you mentioned insurance. There is actually an insurance protocol. It's also, again, it's open source. There's not a company that takes the fees in the middle. All the fees that could be accrued are distributed to all the different members of the mutual. And so that would be one example that also covers the contract risk in DeFi.
Yeah, so I mean, let's maybe take a short gap here. So basically, yeah, we have established protocols. You and me, we believe this is kind of a better banking system. It's unhacked so far. And now, of course, what I think is developing, and what you're also heavily investing in, is the DeFi space, right? So DeFi standing for decentralized finance. Maybe you want to just briefly introduce what decentralized finance means and what it stands for?
Yes. So it is that principle that also applies to what I just described, that you have, instead of sort of a company with closed code, offering you a money market, right? Where you put the money in, you don't know what's happening, you expect them, trust them, that, right? This is actually a money market that's on Ethereum. It's called Compound, where, again, you can look at the code, you can see exactly what happens. You get mathematical cryptographic proof that this is what will happen with your money. And so that is, for example, a money market, which is now global. Means that anybody can tap into it. The way it works for now, it's over collateralized. So I say maybe I have $1 million worth of Ether, and I want that exposure long to Ether, but I also want some extra yield. I want to do something with this. So I lock up this collateral of Ether, and I draw a cash loan, usually in DAI or USDC, in a stable coin. And then I have that liquidity. I can put that money, that stable coin, to work, or is it expenses or whatever. And then do
you want to maybe do an example on it? Shall we show maybe quickly how this works? I actually set up an accounts here. So this account has, a couple of Ether. It has a very small amount of DAI. It has C DAI, we'll just get to in a second. And then it has 146,000 USDT as well. So the cool thing now is basically it automatically detects this account. So you can see here on the top right, 0xF2533B. So if you check back here to my MetaMask, this is exactly the account I'm using here. So it shows me the same amount. And you can also have different accounts here. Then suddenly, it basically pulls out of this account. It pulls already the information in, right? So it shows me already, aha, I have a supply here going, which is DAI. I'm earning 2.73%. So my supply balance, even up here, is a total of $50,000. My current interest rate is 2.73. I'm not borrowing at the moment, and that's it. Basically, what I basically can do now, I can click on it, and then I can say, I could probably say, let me remove $100. So I need the money back for some reason. Then I say withdraw, and I can say withdraw, and then it confirms the transaction. Another MetaMask goes up. And I just want to show how fast I can basically move in and out of this account. So I just say, confirm. And then it's, of course, confirming on Ethereum network. And then I should have, and then, now, of course, it's being mined, right? So this takes a couple of seconds on Ether. But with that, I should have $100 more in my MetaMask. Of course, I didn't remember the number now. But let's see.
Right, and now think about this. This is a global capital pool, so anyone in the world can do this that has internet, a decent enough computer or whatever. And so
exactly. So now 213. So this should jump to 313. And yes, Ethereum, is not, as we know, it's not super fast yet, but it's pretty fast. So in a matter of couple of seconds, although something maybe it's my internet connection now that it's a bit technically slower, but I mean, generally, this should be done in there you go.
There you go. And for high value transactions, this is fine. 15 seconds is okay. Again, compare this to manual process at the bank, maybe paperwork to go there.
Exactly.
This is, I mean, this. So yes, I would say, you don't need CryptoKitties where you have, like $5 cats that you're sending back and forth that need to be mined with security and the speed of Ethereum. If you check on the transaction, you can see, so if you close that and then Vertragsinteraktion bestätigt, click on that one, right? And then on the arrow up, so you can see there's an Etherscan. And so again, so this information is public for everyone, right? So this is what I mentioned before. Anybody in the world can see this information that's pulled directly from the Ethereum chain, and there's no question about it. Nobody's going to argue that, okay, the transaction was mined, it's success. Nobody's going to argue now that he got $100. I think the MetaMask, maybe Ethereum, no, it takes a while to update your DAI balance, right? But this is, again, there's no, we don't need to argue about it. This just happened. And this is, again, at a cost of, you paid 39 cents for this transaction. The $100, you could have also moved $100 million. Same cost.
We actually got the DAI, right? And so this maker framework obviously is sitting on top of the Ether blockchain. And that's probably the core second layer, right? That you need to kind of do compound, do DYDX, Uniswap, and all the other stuff.
Yeah, so Maker, you can think of like it's a central bank on top of Ethereum, and you can print your own money. You can print your own US dollars.
Yeah.
Completely permissionlessly, you just go there and do it. And the way you do it is this dollar that you're printing is always backed up by other digital assets.
Just open the website because I love this website.
This is also the first version. If you go to oasis.app, this is a new version. This is for single collateral DAI.
I know, but I wanted to show where we were like even 6 months ago. This is what it looked like, and just check out it's right. Let's be honest. Let's go to oasis.app,
I think,
which has a bit nicer interface.
So MakerDAO has raised, I think by now $80 million among others, and recent Horowitz, which by the way just announced yesterday that they have a second $550 million crypto fund. Which is a bullish signal. I think that Andreessen Horowitz has a very has a prime institutional LP base, and for them to give them another after $350 million fund to give them $550 for the next fund, about a year and a half afterwards is quite bullish.
Yeah, and I mean, guess where this money is going, right? If they're already invested in platforms like MakerDAO. Yeah. So, good luck to the banking industry, I would say, but see what happens. So, explain a bit what Oasis is doing, or?
Yes. So this is the sort of the interface, one of the interfaces that plugs into the MakerDAO system. So you could say borrow. So let's print our own money.
Of course, I have to connect my wallet. So here I'm using MetaMask. So automatically detects my MetaMask wallet up here. And then, all right.
Get started. So you have some ETH. So we can take the ETH as collateral and print our own money. All right. So this means that now he has Ether. Wants the exposure to Ether, he takes it as collateral and locks it up.
Shall we just let's just use everything?
Do a bit less so you have gas left. Do maybe 7.7 so you have some gas left. So now if Ethereum falls to $107, this is when he would start becoming under collateralized, and the system would automatically sell his Ether to get the money back, and to make sure that this DAI, this stablecoin that he's printing now, is actually covered.
Yeah. So let's just do it.
It's backed up.
So open vault, and now I want to have, so of course, MetaMask notification pop. I say I'm fine with that. Dear bank, I would like to have my loan. My is being created, estimated time 30 seconds. I can leave the website. And now, of course, you're on the top right, it's creating the vault. So let's wait just a bit. So yeah, I mean, I think so this is Maker. I think you also made. I want to leave some time in the end for some questions. So you also wanted to walk us through some of the newer platforms, right? So Compound, I mean, it's around or MakerDAO has been around for how long? 4 or 5 years now? Or?
Yeah, long time.
long time, and then you had Compound, DYDX, set protocol launching kind of last year, and you have now invested in a new company called FutureSwap, right?
Yes. So
Or new platform.
FutureSwap is also a DeFi project, meaning that the code is open source. There's no company that owns the asset or anything. It's actually all run by token holders. So there's also, anybody who trades or provides liquidity gets is incentivized at the beginning with tokens. So they distribute the ownership of this network, of this protocol, among people who have been using it or have been supplying liquidity to it, to sort of create this decentralized sort of network of different stakeholders, ideally all users and people who are involved in it. And the idea is that there's been an innovation in DeFi that happened around exchanges. So the classic model for exchanges is that you have an order book, and now you need liquidity because pretty much nobody's trading. And then once a day, someone comes in and says, "Okay, I want 100,000 shares of this," and you got to make sure that at this moment there is inventory for 100,000 shares, and the price slippage is not going to be massive. And so now what you need is market makers. And so anyone who's been involved with an exchange, the amount of money and effort that is spent on market making and providing liquidity is monumental. And again, the way they monetize is mainly is through spread, right? They always sell this to you at a slightly worse price, and you still have slippage. So now you have futures trading, highly leveraged futures trading is extremely popular in crypto. I don't think they're doing it for professional hedging reasons.
That's why.
Well, because
volatility, I'm wondering, or
yes, because it's fun to gamble on the price swings of crypto, which are already quite insane. But then on top of that, you leverage that with 20 to 50x, and then so it's a huge market. The market exists. There's demand for it, so that's all I can say. But the problem is that it is in really old, technically crumbling venues like BitMEX, etc. But what they have is that liquidity. And this is sort of why, I don't know if anybody's familiar with Craigslist, which is a very bad product. It's a really old website that was made in the 90s for classifieds. But everybody in the US still uses Craigslist because everybody, it has liquidity. Everybody goes there whenever they think of selling a car, whenever they think of buying a car, and you just can't get rid of this thing. And so there's a similar thing with BitMEX that has, up to $1 billion in open interest at times. So if I want to do, $100 million trade, I'm going to go to BitMEX. Now, it still has quite a lot of slippage, actually. So what the ideas of FutureSwap is that you, instead of an order book, you actually replace, and market makers, you actually replace them with a mathematical formula. You basically say it's a bonding curve, the same way that Uniswap has. You just say it's predetermined by a mathematical formula. Depending on the supply and on the demand, this is how the price will move on that curve. And you can optimize actually that curve for specific use cases. So one who really did that is a project called Curve, which focuses specifically on the swap of stable assets on stable coins. Right. Okay. And so the Curve design is basically, so it is the best place. If I want to switch DAI to USDC, you should do it on Curve. So the best example was there was and maybe sorry to add to that. So it is a price curve. It's not an order book anymore. And anybody can add liquidity in a very easy way. So you just go there and say deposit liquidity. And then you are, when orders come in, your liquidity fills that up and swaps. And you say, okay, I'm happy to have DAI. I'm happy to have USDC. Do this automatically for me. And there's always like a tiny spread, if at all. Or sorry, there's no spread and there might be a fee. And so famously, there was a $1 million trade in one go between DAI and USDC that had a 0.0054% slippage. That was a cost, right?
Okay.
So that was a cost. Yeah. You can't do that if you go to Binance. USDC USDT order book is the sort of the thickest order book in all of crypto for stablecoins. You will never get that spread, which is basically was zero, and on top of that you pay fees. So you already have a very clear case where the spawning curve has been optimized for stable asset swaps. And it just blows centralized exchanges out of the water. It's just impossible because, again, you have spread because you need to pay the market makers. On top of that, you have the exchange fees. Just impossible to compete for Binance with that. And so,
but I mean, we're active. We're active on Uniswap. I mean, the problem is, and I'm interested to learn more about Curve, because on Uniswap, for these deep pools like Ether DAI or like you said, USDT DAI. I mean, even USDT DAI, I'm not 100% sure if the liquidity is that big.
Yeah, so I would actually add that we're actually not a fan of Uniswap. A general purpose bonding curve is very difficult. So it turns out that Uniswap in practice now is very good for small long tail trades. You have, long tail token X, whatever it's called, and I want to buy $20 of it. I think then you can't beat Uniswap, but it is actually pretty capital inefficient. You have the risk that if you provide liquidity, you always have, if Ether goes up a lot, you're going to lose a lot of money compared to that. But Uniswap was the sort of the innovator of a bonding curve for exchanges. Now they're set up very broadly, and we actually believe that you can optimize these bonding curves, which is mathematical optimization exercise for specific use cases. And so Curve has done this, fantastically for the swap between stable assets. So it's stable coins right now. The next one will be the different tokens of BTC on Ethereum, which in theory should also be price stable. Now to add
on Curve, you can. I mean, so just one question. So basically, because the problem here on Uniswap obviously is that I can only trade Ether-based tokens, right? Like DAI, Ether, USDC, right? Something USDT on the Ether network and so on, right? What about Curve? Can I also trade across chains or?
No, Curve is also Ethereum-based.
Okay, yeah.
And it's use case optimized, right? And so Future Swap takes the same principle for futures, leveraged futures trading. And so no order book and market makers with spreads, but you have a price feed. And then the liquidity that you can add, anybody can add, basically serves to fulfill these orders, and the price moves depending on and the price actually here doesn't move. It is just a price feed. So it's pegged by, they take the DAI
let's
price
open this.
from
So
Coinbase
Curve,
or Chainlink.
What's it called? Curve
So that is curve.fi, and I think anyone who remembers 90s 2000 internet is going to love the design.
Yeah. Oh yeah, nice. Okay, MetaMask connecting. How long are they around now?
I would say a bit less than maybe 4 months.
Okay, cool. Yeah. And they again have built something on top of Uniswap, or they have kind of dived, like kind of used that platform again, or they just kind of moved aside it?
They copied that code base.
Yeah.
Which again is coming back. The cool thing is that everything is always open source, so you can just copy it, which also means that the rate of innovation is much, much faster.
Yeah.
Right. So they copied it, and then they optimized the curve and the price curves for stable assets.
Okay, so basically I can put in, I can move from DAI to USDC, which is pretty handy, or let's say USDT, which I'm always using for invoices of us.
Maybe try USDC to USDT, because the peg of DAI is quite off right now, so it'll be easier to see what the spread is if you do these ones, right?
Yeah, but I don't have any USDC here. So I just
well,
have to use.
Sorry, I saw a lot of USDT in your wallet, so maybe do that too, whatever you want.
USDT. Yeah. Okay, that I can do. Yeah, that's plenty. And then you want to go from USDT to
USDC, let's say, because both of these are,
interesting. So exchange rate is 1.00313. So where do I see the slippage? Here's the slippage, 0.5%.
You could set it,
which is,
but yeah.
Or I can set it myself. Okay, cool. Yeah. Okay, got it. I mean,
so now something to add to Curve, something that's extremely interesting and tells you another, kind of mind-blowing aspect of DeFi is all these protocols are composable. You could think of them like money Legos, right? So MakerDAO is a money Lego, and you can plug that into Curve. Compound, you could plug that in there as well. And the best example is that you went to Compound, you have money in there, which basically is the right to withdraw the DAI plus the interest that is accruing. And that position again becomes tokenized, right? You got a token that is called CDAI.
Yeah,
right?
I show this here, yeah.
Right.
So for example, here, if you go my MetaMask, I have the CDAIs here. There you go, right? There it is.
Yeah. So this is the digital representation of his right to get the DAI back plus the interest, and the interest keeps going up. Yeah. So that itself is tokenized. Now, what you can do, you can take this token and supply liquidity as a automated market maker on Curve. So you can add the yield that you get in interest to the yield that you will get as a market maker on there, because you get you don't have slippage anymore or spreads, but you have like a tiny trading fee that you're going to get.
Yeah.
And so if you go, let's say you click on at the bottom, you on the curve pools, you let's say click on compound.
Yeah.
And then you go on deposit. Right? So now you could deposit that tokenized position on compound. You could deposit it as a liquidity provider into curve. And that means that you will make the slippage on the price curve better because there's more liquidity.
Nice. Yeah.
On top of that, you get a tiny bit of fees, and then you add basically the yield from interest. So you have this interest token, plus you're going to get trading fees.
Yeah.
And this is an amazing example of the composability of DeFi and how,
Yeah.
you know, and again, Curve didn't have to ask Compound for any permission to do this. They just built that. So this is, you know, we're seeing this Cambrian explosion of innovation in the DeFi space because of these sort of basic parameters. And now maybe to end or come back to FutureSwap, it's a similar principle that I can just provide liquidity into FutureSwap, not for stablecoin exchange, but for, you know, for leveraged trading on Ethereum. I think they have
open it here.
They've had a test alpha for a couple of days, and it's going to come back, I think, next week or something. But yeah, here's it, right?
Okay. Yeah.
So
cool.
I can add, right? So anybody can just add liquidity in there and you know, reduce the slippage, and you get part of the trading fees, right? So this is open to anyone except, you know, compared to, you know, highly specialized, you know, market making firms that have special deals with the Deutsche Stock Exchange, whatever, and it's not accessible. And the same principle here is you don't have an order book, you have a price feed, and then you trade against that price feed basically with the liquidity that other people provided.
Yeah. Cool. I mean, let's wrap up with maybe with one final question from me, and then we can open up to the other viewers here. You know, your own exposure, right? I mean, where are you sitting, right? What's your own book like? So and then, you know, what's the biggest pain, you know, that you see right now in the market, and how do you solve it?
So my personal exposure is a lot of ETH, very, very bullish at this price point on ETH, a little bit of Bitcoin, and a little bit of Bitcoin, and I think there's some merit to, like, you know, an independent price feed of some ultimately scarce asset. You know, I think there's some merit to Bitcoin with that. I don't know if the rest of the world's going to see it as the censorship-resistant alternative asset store of value. I don't know, maybe. And then a smaller number of sort of very specific software network sort of altcoins. And the biggest challenge I see right now is a little bit in DeFi is this sort of, it's unregulated, which I think is very, very to be welcomed, because you want this experimentation, right? So real innovation always is almost like an accident. You need a large number of experiments to happen for ultimately for things to filter through that are really groundbreaking and innovative, right? People just can't predict that, let alone any regulator is going to cut down any sort of experimentation in the space, right? However, we still have to, the good thing is that in DeFi we have, it's $1 billion in value that's sort of locked up in DeFi now. So you need real money to test these things, right? They need to be out in the open, they need to be hackable, so that the ecosystem itself kind of, you know, becomes more resilient and, you know, and has real economic incentives behind it to become secure, right? Imagine all the code from the Deutsche Bank was open source. This thing would get taken offline in like half an hour, right? So it shows you how weak it is, versus all these systems, they dare to put everything out in the open and be hackable, right? And so they become extremely resilient over time, and you need real money for this. Now, you do have hacks that happen.
Yeah,
I would make the argument that, you know, all that money, especially in DeFi, this is not an old lady that, you know, got kind of taken advantage of, you know, and they put the money in DeFi. No, this is all, you know, very technology savvy early adopters that, you know, bought Ether at 30 cents and it went through the roof, and now they're millionaires and they're playing around there. So if they lose the money in hacks, I would make the argument that, you know, it is not the end of the world.
That's hard.
Yeah, and most of them know what they're doing, and they get a lot of yield on these things to take that risk. However, obviously that doesn't scale, right? We need to move towards something safer, because if you want to grow the market and also get, you know, at the end of the day, get, you know, my mom's money in there, it needs to be safer. So I think Nexus Mutual, this insurance protocol, is one way to do that. So even if it isn't safe, at least you got insurance, and you're going to get paid out. But we do have some teams. Again, this is permissionless, right? So anybody can create a protocol and say, hey, 100% yield, and no risk. And this has happened. So BZX was a very famous hack recently. The writing was on the wall. There were auditors that have told since September, this is an exploit, this is going to happen. But a lot of people sort of don't, the signals for the end user aren't there that much. And so I think the industry we're starting an initiative actually now to basically get auditors to stake on Nexus Mutual towards a contract, to signal because an audit from a security audit firm
on where
doesn't mean anything. On this insurance platform called Nexus Mutual.
Okay.
Right, because a code audit from a security firm doesn't actually mean much. It's just an opinion. It doesn't mean that it's safe. And right, and
so they have to audit, and they also have to stake against it. So they say, look, we are putting my money. They're putting their money behind it. That's tough, like it's a trading principle, right? I mean, it's a lot to ask for.
Yes, so we're working on that initiative, and then for the market to expect the protocols themselves to buy insurance on behalf of their users. So Paraswap was the first one. It's a stablecoin swap similar to Curve. They always have $1,000 Ether, 1,000 ETH worth of cover for the users that they bought in case something goes wrong. And so we kind of hope that this becomes best practice, and users learn to look for the signal. And if there's a protocol that doesn't have that, they stop interacting with it. So I think the security aspect, because crypto already has the problem that the media is very happy to report stories of hacks and other terrible things, and crypto just keeps giving it to them. And I would actually make the point that most people that don't hold any cryptocurrencies actually really don't like cryptocurrencies at all, because all they hear on the sidelines is, oh, another hack. Then they don't hear anything for the next 3 months, and then another hack or someone lost money. And so they think it's dangerous, and so we got to make sure that DeFi doesn't get that reputation either.
Okay, cool. Awesome. I mean, thanks very much for the answers. I wanted to briefly give the floor to anybody else that wants to ask a question. I think you have to go off mute to do that. But feel free. Anybody any questions?
Maybe I can ask a question, Lasse. It's Ray. Can you talk about how far are we from? Because at the end of the day, consumer adoption is what makes this whole thing work, and you elaborated on it. But are there examples of projects that are already onboarding consumers? And in your view, what are we talking about? Is that a 5-year investment? Will it take 5 years, 10 years, more? What are your views?
Yeah, this is a very good question. So it's basically a layered approach. If you also look at the internet, there's lots of protocols that we don't even know about, but that we are using right now for this call. And Google Meet is actually an application on top. And so for this Internet of Money to mature, it is also a software stack, different layers of software and protocols that need to come together. And at the end, you have the application layer. And so for us, we got in very, very, very early where the application layer was absolutely non-existent, and you didn't even have any software entrepreneurs that could build UIs in a million years. And it started in 2018. We had the first very good sort of application team come in. It was called InstantApp, and they built a beautiful interface to interact with all these protocols, which were made by hardcore cryptographers who had absolutely no idea about interfaces, etc. Since then, this was 2018 fall, and since then we've seen a few teams come in. Xerion is a very good one that also they got funding from Placeholder in New York, so they're well capitalized, and they build very beautiful interfaces that make it extremely easy to interact with these protocols, and they are a security layer. They choose which protocols they can allow their users to interact with. And they sort of act a bit like it's centralized, but they act a bit like a security layer saying, okay, I'm not going to integrate Curve just yet because it's been live for 4 months and it has one audit, versus MakerDAO has, tons of audits, hundreds of millions of dollars live for years, right? And so I would say we have Argent is another mobile version of that. They've raised, I think now a total of $15 million. So well-funded, very, very good product team, built a beautiful, very easy to use Ethereum wallet. I would recommend actually to try that out. Argent. It's getting to a world-class user experience. Something to, why is Uber so successful versus MyTaxi? It's just because it was an amazing user interface team. And Uber is beautiful to use, and MyTaxi is just, I just want to throw it on the floor. And
exactly.
I mean, the payment process of MyTaxi is just mind blowing. Anyways, so and this again is also, it is different teams, so it's very hard to be good at software at everything. You need a team that is specifically good at building, end consumer applications. They're not going to be protocol engineers, the same way that the protocol engineer won't know how to build a beautiful wallet. And so we have Zero and Instagram, Argent, that are coming live. Dharma in the US. And so Dharma would also one I recommend to download. Now for these guys to grow sort of 20-50 million users and accommodate them, I would say that's 2 years away, maybe 3 years, right?
How many users are on crypto, right?
DeFi has around 150,000.
Exactly, right? And like total wallets, I hear numbers between 30 and 50 million or something, or what's the latest number you heard?
Right, yeah, but it's also, the thing is, one challenge of measuring, we're still trying to figure out what is a meaningful metric, because the daily active users is a metric from the consumer internet where it was about advertisement, right? The more people every day look at my website, I can give them ads every day and I make more money. And so that metric, you don't have that. If someone holds Ether, I don't need them to log into the Ethereum wallet every day and check if the Ether's still there, right? So it's kind of hard to know what the meaningful metric is for engagement, but we know the numbers are still very, very low and it's very early. So Ray, come back to your question. I'm careful about timelines. This is like the politician, never give any timelines. I would say 2 to 3 years. Usually what happens is these curves, they're very slow, and then when they hit an inflection point, then the growth is very, very rapid.
Maybe related to it, how do you how do you put Terra into all of this?
Yeah, so Terra actually is a good example of a network in East Asia. They're based in Korea, but it's basically everywhere in Asia except for China. And they actually hit that already on the head. They also have a team that actually builds good applications. It's also a team that has previously built the largest South Korean e-commerce player and now has sold it to the Lotto Group in Japan and Korea. So they basically have the whole package. They could build a protocol, they could build a beautiful end consumer application, and they could talk to e-commerce shops and get integrated. They're at like 1.3 million users now in about 8-9 months, have cumulative close to $1 billion in transaction volume. And these 1.3 million people are actually not, they're not crypto people. They don't have to back up seed keys and do wallet recovery and any of these stuff. These are people that are buying diapers online, and they check out and they see sort of, some discount if they pay with Terra, and they connect their bank account. And their bank account buys their stable coin, sends it to the merchant, and it's settled. And so I would say Terra and East Asia, particularly just the technology adoption in East Asia is much, much quicker. So I would say Terra itself could probably have 10 to 20 million users in the next 2 years.
Any other questions? Anybody else want to dive in here?
Yes, thanks a lot for the presentation. It's been very interesting.
Wolford, do you want to introduce yourself quickly? Just so, because I think Lasse doesn't know you.
Yeah, sure. I'll turn on the camera. Here we go. Hi. Yeah, so I've from the background, I'm more a banking guy, and we come more from the traditional space. So what we've been doing is basically build a platform for investment intelligence. We started in the traditional space, sourcing signals from hedge funds, from quant hedge funds, standardizing the signals and allowing to really benchmark things peer-to-peer in terms of the intelligence, not just the track record of a fund, which doesn't compare the intelligence, actually just the kind of risk taking rather than the intelligence. And the idea there is basically to use also blockchain in order to audit that intelligence, because that's always the problem, the issue is, especially in the quant space, you always have this great backtest for the past, and then you start trading them, and it doesn't
Suddenly
work.
doesn't work.
Exactly. So the difference here is, instead of believing in backtest, we source the signals and we put them in the blockchain, so no one can basically put our ethic into question, and we have an audit of this signal. But so that's what we do. We also started to collect signals in the crypto space, which is also interesting. Yeah, so that's an overview of what we do at Sunostro. I think we might have had some contacts in the past with 1KX rings a bell. So there might be have some contacts also with our product manager, who is based in Berlin, John Krebel. Maybe you know him. Anyway, so that's what we do. But the question was, with respect to MakerDAO, I think it's a really cool product. The thing is, if you start to change this basket quite a lot on a daily basis, you kind of create an investment product to some extent. Is that also a use case, or is there another platform that would cover that use case in DeFi?
Yeah, there's one. It's called Set Protocol.
Excellent question.
Yeah, it's actually we had this on the list to speak about that.
That was a high pass.
And that is, among others, is basically ETFs, right? So you have pretty passive trading that can just be automated. ETFs still have a high starting cost. You know, for a manager to submit an ETF, get it approved, etc., is quite expensive. And then again, you have regulatory overview, compliance costs, etc., which you put the smart contract on Ethereum, you have it audited, you have it peer reviewed, you make sure of that, then the thing just runs, and that's it. And you pay like minimal gas fees, and the thing just runs, right? So ETFs is like a fantastic example of that. They also have broadly this sort of social trading paradigm as well, which, you know, eToro sort of pioneered this, working really well. So basically, yeah. So asset management, I would say Set Protocol from San Francisco has done a really great job there.
Okay.
Lasse, what do you think about legal, right? Because you know that we have structured a security token, right? For the reason that once you put utilities together, right, Bitcoin, Ether, these are confirmed utilities, but once you put them together in a token, they become a security, right? And especially trade in it in a certain strategy, then that should be applying as well. And this was the main reason why we did that. So what do you think about Set Protocols then? What do you think about the Set Protocols? How do they get away with it?
Yeah, so this is a good question. So they are actually they are quite what we call knee benders. So people are just like, oh no, here's a regulator, I'm going to bend the knee and do everything right I could. So, and part of the reason why Silicon Valley won the last 30 years of innovation is because they have people that push into the gray area, right? They don't take the current system, the rules. They're like, you know what, screw that. There's a better way.
Yeah.
And most companies that are really big actually have pushed into gray areas. So Uber did, YouTube was a nightmare legally until even Google bought it, etc.
Yeah.
So you kind of, Airbnb did that, right? So the idea is you push into into a gray zone, but if
gray zone, it's not a gray zone, but anyway,
or you might, right? You don't do it for its own sake, but you might, and you become actually that big that you adjust the rules, or the rules you basically create a new market, and rules are sort of reestablished, right? Set Protocol actually is fully compliant as well. So they are actually very, very careful about what they offer, and they are sort of also actually more on the knee bender front. But even there, they're not guaranteed 100%. Like no attorney can certify them and say you can do this and you're going to be 100%, sort of risk free.
Yeah. But then that means that they must be issuing like offering memorandums for each token or something. And these must be.
No.
How are they compliant?
Basically, the products that they offer are the most successful one is basically simple trading strategies, 200 moving day averages, buy in, buy out, etc. If it goes up underneath it, you don't need offering documents for that. So at the moment, they're limiting it to things that, at least on their own platform, right? So they have the set website, where then they also have products built on top of the set protocol that don't require offering documents, etc.
I guess your OM is replaced by a smart contract, right? That's the whole point.
Yes.
Well, for sure, right? But I mean, still, you know, like the argument would be that the investors have to be informed about the risk, right? And you have to sign it off. And you need to make sure what the investors are they accredited, and these kind of things. And on set protocol, you don't need to, right? Like, you know, you just log in with the MetaMask I just showed you, and you just buy a protocol, right? That trades the ether for you.
Yeah.
Right. So there's no.
Yeah.
That's not it. I want to close it here. We're just 3 minutes past the hour. Thanks very much, Lasse, for joining us, and everybody else for joining as well, and the questions. And yeah, I mean, let's talk soon, and see you guys around.
Thank you for having me. Sorry for the delay. Bye-bye.
Thank you, guys.
No worries. Thanks, guys.